$300 million chip industry to a data center opportunity that represents about $1 trillion to now an AI factory, an AI infrastructure industry that will be measured in trillions of dollars. And this is the exciting future that we're undertaking.
For more on what's ahead for the chipmaker and others that it's working with, Bernstein Managing Director and Senior Analyst, friend of the show, Stacy Raskin, is back with us. And Stacy, Jensen Huang is known for making grand statements, right? So far, it's worked out pretty well for him. But as we try to tease out from that keynote what is most important for the company and for shareholders, what stands out to you?
I mean, look, so you're right. He does make sort of grand statements on the opportunity in front of him. And so far, his track record on that's pretty darn good, right? So I think, at a high level, that continued confidence, the idea that they're kind of on this path towards something even greater than what they are, I think for the long-term investor is very important. There were some very interesting, like nearer-term announcements as well. There were a bunch of products and everything. I mean, fine, but I thought the most interesting one was that they are opening up what they call their NVLink technology to third parties. They're kind of NVLink is a high-speed interconnect that allows them to connect many GPUs together. And so far that's been proprietary to Nvidia. And so they are partnering with a number of the AI ASIC vendors, Marvell and MediaTek and Allchip, as well as some of the CPU vendors, some new ones like Fujitsu and Qualcomm, to now make this available for third parties to further sort of grow their ecosystem into other parts of the market where they're currently not. I mean, they right now are sort of actively competing with them. They're going to try to go. So I thought that was very interesting. It's not something that at least that I had expected them to do. But that's what they're doing. So that was one of the more interesting announcements that I saw.
And that idea, Stacey, of opening up the ecosystem to other chip makers, why do you think they made that decision and announcement now, one? And then the partners they announced, Stacey, so Marvell, MediaTek. I'm curious to get your take on those partners, but also your take on who we didn't hear about.
Yeah, no, you bet. And so they sort of kind of announced it a little bit before. They announced something with MediaTek at GTC that sort of implied some of this. And so this gave us a little more concrete details on what they're doing. So they are partnering with other ASIC vendors, again, like a Marvell or an Allchip or even a MediaTek that make AI ASICs for other players. Look, I think in some sense it probably is an acknowledgement that the ASIC opportunity is real. And look, I figure if folks are doing ASICs, they're going to do them anyways. You might as well try to extend your ecosystem into that and make them partners as much as you can. So I think that's fine. You asked who was not in it, though. It is interesting. Intel and AMD and even Broadcom. So they actually have a competing interconnect standard. It's called UA-Link. I think it stands for Universal Accelerator Link, I think. But it's like an open source competitor to this NVLink interconnect technology that they've been trying to build. And so in some sense, this is encouraging other players not to go down that route, but rather to partner with NVIDIA on that interconnect technology. I could also imagine that those other guys, Intel and AMD and Broadcom, probably be less interested potentially in partnering with NVIDIA, and they're clearly not. They're going to go try to do their own thing. But you are sort of setting up a couple of different paths, and you already have one. I mean, the NVIDIA ecosystem is already pretty well established. To the extent that Jensen can help to drive that into some of those other areas, it puts a lot of pressure potentially on some of the up and coming ecosystems. It's always hard to get new ecosystems kind of traction to get them started anyways. So
the stock of Nvidia has recently experienced some erratic trading. Following the Trump administration's announcement of an easing of its tariff policies, the company's share price experienced a sharp recovery after plummeting due to worries about the demand outlook for sophisticated artificial intelligence, AI hardware, and new import taxes that threaten to disrupt international trade. Following the Trump administration's change in tariff policies, Nvidia's stock has surged, leading some investors to question if it's too late to invest in the company. Continue reading to see what two Motley Fool contributors believe will happen to Nvidia in the upcoming 3 years. Since the AI revolution began to gain traction a few years ago, Nvidia has been in the forefront of developing sophisticated graphics processing units, GPUs, and accelerators. As of right now, there isn't much evidence that rivals like Intel and Advanced Micro Devices are overtaking the business. Although it appears that the need for those processors will be mostly centered in China and its allies, significant advancements for Chinese designers, notably Huawei, may eventually appear. AI has the potential to give governments and businesses significant competitive advantages, So there will be strong incentives to continue making significant investments in the kind of powerful technology in which Nvidia excels. Better yet, the company's CUDA software platform, which enables developers to maximize the potential of AI processors, has reinforced its competitive moat. Because of this, AMD, Intel, and other competitors will probably find it extremely tough to defeat Nvidia in the market. Nvidia has more freedom to experiment in other potentially explosive fields, such as robotics and agentic AI software, now that it is generating impressive sales and profit margins. Since competitors like AMD and Intel are already struggling to compete in the AI processor market, it is conceivable that this will limit their ability to invest heavily in areas outside of their core strengths. So, what implications does this have for Nvidia's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on Nvidia stock in the comments. Your support truly helps us grow. Now let's get back to the video.
Your view on Nvidia, and especially how this market trades until we get that report. It feels like we've gotten a lot of confirmation on the quote-unquote AI trade and big investments, whether it comes to chip buying in the Middle East or CapEx investments being maintained here in the U.S. But we won't really know until we hear from Nvidia during the earnings report. What are you expecting from that earnings report? How do you think the market trades until we get it?
I think the most important thing to come out of this past earnings report is that AI is more important than tariffs to the stock market. It might be hard to believe, but I want you to know, and Michael Sembelis at JP Morgan has actually done this research, the term AI was mentioned 2.6 times more often than the word tariff in this last round of S&P 500 earnings reports. And if you ask me what saved the stock market this April, I have to point to the massive gains in the Mag 7 and other AI-related names when one by one, every single important CEO in cloud computing and chips and software came out and said, not only are we affirming our spending guide for CapEx, in some cases, we're actually raising it. If we didn't get that, we're not in an S&P that's 3% from the high. Anyone who wants to disagree with me can, but they'll be wrong. And I have the data to back it up. This is an AI-driven tape. This is still the most important theme in the entire market. Yes, there are other themes. Yes, there are other sectors doing well. But absent AI, there's just no chance that we would have pulled this spring out of the hole the way that we have. And that's because of the affirmed guidance on what's happening with this investment mega theme. So that's how I feel about AI in general, and NVIDIA is the most important company. NVIDIA's situation is it's the sun, and AI is a solar system revolving around it. So I'm long. I don't know. There's a lot of words to tell you what you already know. I'm not going anywhere.
Were you excited at all, really quickly, because we're going to move on, about the Foxconn TSMC deal that they announced, where they're going to all work together on these AI factories to build supercomputers? I mean, it seems like the business they're already doing, but they're kind of bringing in even more partners. They already have a kind of an ecosystem of partners, but two new ones.
Yeah, I guess that's great because it's, we want to accomplish two things. We want to maintain global dominance in AI, and we want to have the companies in that arena profitable. And unfortunately, that means manufacturing a lot of things, not just chips, outside of the US. But we also want to acknowledge the fact that we probably abandoned technological manufacturing to a way greater extent than we needed to over the last 30 years, and the pendulum should swing back. We should be able to make more than we currently can make in the United States. I think there's room to believe in both ideas. So yes, that's a good announcement. I don't think it would change my opinion on whether or not to own Nvidia or any of the related companies, but sure, we definitely want to see more of that.
It's likely that Nvidia's stock will continue to see high volatility this year due to the substantial macroeconomic and geopolitical uncertainties that lies ahead. However, Nvidia's dominance in the AI processor market should continue to support the company's robust sales and profits, as well as its forays into new markets. Over the next 3 years, Nvidia still confronts a number of significant risks, but in my opinion, the most important ones for the stock are possible macroeconomic and geopolitical developments that could affect the entire market. Before Nvidia became well known in the era of generative AI, it had been a profitable stock for many years. However, these future uncertainties make it more difficult to predict where it would be in 3 years and if it would be worthwhile to purchase now. Although it had previously achieved success with its gaming goods, its leading position in the rapidly growing generative AI industry helped it become a household name. The demand for its GPUs is still exploding. In the fourth quarter of fiscal 2025, which ended on January 26th, revenues jumped 78% year-over-year to $39 billion. The first quarter of fiscal 2026 was expected to see a 65% increase in sales, according to management forecasts. According to CEO Jensen Huang, the company's most recent generation of AI products, marketed under the Blackwell brand, are responsible for the ongoing extraordinary demand. The management remarked on the opportunity's breadth and depth. Its products are used in many more ways than in the past, and now serve a variety of businesses outside of technology and the internet. The increasing need for GPU-driven data centers, or what Nvidia management refers to as AI factories, is especially pertinent. With a greater focus on machine learning and generative AI, the entire paradigm of how a data center operates is shifting, increasing the market opportunity from $1 trillion to $2 trillion. This is especially important because 88% of Nvidia's income now comes from data centers. Like with any breakthrough technology, competitors will attempt to imitate successful products and provide them at a lower cost. Even while they now still rely on Nvidia, major tech companies like Apple and Amazon are working to create customized GPUs at a cheaper cost to power at least portion of their operations. This implies that even if the market is expanding, Nvidia's market share may not rise in line with it, and additional customer options may weaken its price leverage. Lastly, including Nvidia's valuation in the analysis is intriguing. The forward 1-year PE ratio at which it trades is just 24. That can be a sign that the market believes the business is slowing down. The market may be pricing in the effects of competition and saturation, which could explain the share price decline. However, it's also possible that the company is expanding quickly enough to meet market expectations, which suggests that this growth stock is a good value. That may indicate that it is undervalued, and over the following 3 years, patient investors may benefit from the discrepancy between the market's view and the reality of what is approaching. To stay informed about the latest developments from Nvidia and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on Nvidia stock, so please share your opinions in the comments below. Now let's dive into today's video.
Well, one of the other interesting partnerships that they announced that NVIDIA talked about, or I guess Qualcomm talked about, is with Qualcomm, because Qualcomm is now going to make custom CPUs that will work with NVIDIA's GPUs, as I understand it. And I was reading a recent note of yours where you talked about that you're what feels like a lonely bull on Qualcomm. So I was wondering first your reaction to this news and then how it feeds into that thesis on Qualcomm.
Yeah, you bet. So last week there was a lot of announcements that came out of the Middle East, and Qualcomm even there had announced a partnership in the Middle East, I think with Saudi Arabia, to make chips effectively for AI data centers. And I would say as of last week, it was a little bit unclear how that was going to work. Like, so they were going to do CPUs. And then what? Like, so at least now we have a better idea of probably what those plans are. They will presumably be data centers with NVIDIA GPUs. And then, the GPUs have CPUs that go along with them. They will be Qualcomm CPUs. And now it's clearer how those CPUs will actually work with the NVIDIA GPUs. So I think it makes that entire opportunity for Qualcomm at least more credible. I think more broadly, look, people have not... Qualcomm's been tough. It's been a smartphone story. Investors have been kind of hesitant to play smartphone stories. They have an Apple headwind, which is very well known, but Apple is starting to do their own chips and designing them out. And so it kind of limits the headline EPS growth for a while. At the same time, there is a real diversification story, and Qualcomm's talked about this pretty extensively across auto and IoT and other things that makes them less dependent on handsets over time. And, there's an AI edge story, which I think they are a beneficiary, but this makes the overall AI story for Qualcomm better, I think. And it's clearly not getting any kind of AI multiple. The stock right now is about 12 times earnings. Even if I took all of Apple out, maybe it's 14 times earnings. But it makes that diversification story, I think, even more credible than it was. So I think it's good.
Stacy, final question. Spinning ahead, NVIDIA earnings on tap next week, the 28th. Stacy, what are some of the questions top of mind for you on that print?
Yeah, there's some near-term worries just because of the China bans. They were banned from selling this H20 part in China, which is meaningful. It's. I think I saw an article just today that said Jensen had kind of sized it, potentially $15 billion, and that's kind of in line with what we had thought. And I think they're supposedly trying to work around some of the new constraints, and so it's very possible that some of that revenue comes back. But I mean, does it impact in Q2? It very clearly might. I don't think that'd be a shock at this point. I think that's anticipated. But I think some of the noise around China near term is certainly a concern and a question. I think there's also some of the supply chain stuff. This Blackwell transition has been challenging. It does look like they're in production. Jensen made some comments on that last night. But the ramp of Blackwell, like into the end of the year and into next year, I think will be a question. And then clearly, as this stuff from the Middle East and maybe from other places starts to ramp over the next several years, like how can that contribute? Investors have been worried that 2025 could be a local peak for CapEx. And I would say the only ones that have really been worried about that are investors. Like the companies that are actually spending the money don't seem to be worried. CapEx budgets have actually been going up, not down. But to the extent that investors can get confident there's still more growth to be had as we go forward, I think that's for the long-term thesis. I think that's what's most important.
We are going to be tracking those earnings so closely, and we're going to use all of those points to evaluate them.
Stocks have risen as trade tensions have subsided, and they may be about to enter their next bull run. Artificial intelligence, AI companies appear to have recovered and may be poised to take the lead once more after driving the previous bull market higher. Let's examine Nvidia AI stock, which is poised for a surge. Nvidia will undoubtedly follow where investments in AI infrastructure go. It is the company's greatest opportunity, as well as its greatest risk. After the Trump administration implemented stricter export regulations for AI chips traveling to China, the stock fell, but investor concerns were allayed by trade agreements with Middle Eastern nations that included investments in AI infrastructure. The next significant factor driving government spending on AI may be sovereign AI. This would be in addition to the significant expenditures now being made by cloud computing firms and organizations like OpenAI and Meta platforms that train foundational AI models. Nvidia is in a strong position to profit from continued investments in AI infrastructure because of its more than 80% market dominance in graphics processing units, GPUs. It has a broad competitive advantage in the market because to its CUDA software platform and a suite of AI-focused libraries and tools that speed up development and improve chip performance. With a forward price-to-earnings ratio, PE of 31 times this year's analyst predictions, and a price-earnings-to-growth ratio, PEG, of 0.6. Numbers below 1 are seen as undervalued. The company is still fairly valued. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
And it is time now for today's strategy session. The question facing those investors, do you sell the rip or do you buy the dip? Our next guest saying the technical indicators are favoring the latter. Here to break it down, Adam Turnquist, LPL Financial's Chief Technical Strategist. Adam, great to have you this morning. I just mentioned some data indicating retail investors keep buying even at these levels. Are the retail investors right to continue to buy the dip?
We think so. When you look at the technicals over the last month, we had enough boxes checked on the capitulation on the downside. We got the extremely oversold conditions, indiscriminate selling. We had washed out breadth readings. And now on the other side of that equation, we have the recovery. And we think you are, again, checking enough boxes here to set up for a buy the dip playbook. We're seeing breadth thrusts off the lows, notable number of stocks getting back above their key moving averages, leadership, importantly, shifting to more cyclical sectors. We're seeing that in industrials breaking out to new highs, consumer discretionary starting to outperform as well. So we think that playbook aligns with more of a buy the dip backdrop for equity markets. It does alleviate some of the pressure of potentially retesting the lows from April. We think that's an unlikely scenario right now.
And Adam, what exactly should that dip buying activity look like? Like, is it all created equal? Is it across the index that investors should be looking? Is it specific to tech? What are the attractive corners of this market?
Just at the broader index level, we'll start there with the S&P 500. We did gap above the 200-day moving average last week, so that would be a notable spot where you'd see potentially some support if the market starts to fill that gap. And then at the sector level, we think with that leadership changing to more cyclical areas like financials, that's an area we have an overweight view on. Communication services, that's been a consistent outperformer, great fundamental backdrop, great technical backdrop. Those would be spots we'd be adding to positions right now on any type of weakness.
Is tech still defensive in this market?
I think tech is now more of a barometer for risk. And one of the things we were looking for in terms of that checklist to identify a sustainable recovery versus a bear market rally is tech participation. And not necessarily tech leadership, but we're actually getting tech leadership. We haven't seen semiconductors quite break out yet, but overall, the tech sector participating in this rally. And so far, early signs of some leadership there, certainly a great sign for a sustainable recovery here, given the fact that the tech sector is about a 30% weight in the S&P 500.
Yeah, and it's interesting because I'm also hearing some folks say maybe you look at the equal weighted S&P 500 given that sector weighting for tech in your S&P 500 more broadly. Having said that, I am interested in what we're seeing in the bond market. If we can take a look at yields for a moment, because it's interesting to see yields as a potential headwind for stocks, because you're starting to get a little bit more bang for your buck when it comes to the bond market versus what we're seeing in the stock market in terms of earnings. How are you thinking about bonds as a potential competitor to stocks?
Probably thinking about bonds a little too much. I'd classify that as what keeps me up at night, that category, because with the 10-year treasury yield right around 450, there's not a lot of margin of error here when we're talking about a breakout above 458. That's a key resistance level for the 10-year yields. If we break that level, that would mark a further move out of this bottom that's formed over the last month or so and leave kind of 480 as the next area of overhead resistance. I find it hard to believe, if we're talking about a 10-year rallying up to 4.8%, that the equity market rally continues. We think that could spill over into some risk off sentiment and pour some cold water on this red hot equity market rally right now.
And talk to me then about kind of where you're seeing opportunity across the yield curve. Is this a chance for investors to get into the 30-year yield when you do see a little bit more of that yield as it hit 5% on Monday? Or should investors say that's a little too risky given the concerns about the Fed and growth going forward?
We think we're getting close to an opportune time to add duration right now, maybe not quite there yet. Again, if we start to see, for example, the 10-year break 458, we get 475, 5% type 10-year. That's a new discussion in terms of duration, and the same thing on the long bond through 5% or north of that would be an area that we'd start talking about adding duration. But right now, when you look at the front end of the curve, you don't really need to take a lot of duration risk to add attractive yields and attractive income for portfolios right now. So we don't think you need to go into high yield. We think you can stay within more of the high quality areas of the market, and you don't need that added duration risk at this point.